In this video, we continue our discussion on Chapter 11, in which we go over market outcomes, where in our last video we used game theory to understand the price-making decision process between oligopolists. In today's video, we seek to examine market outcomes in an oligopoly by considering some preliminaries in order to go over market outcomes, where, in regards to our preliminaries, we saw through coordination that an oligopoly as an industry seeks to mimic the monopoly market structure, where coordination was possible through price fixing, price leadership, as well as through the allocation of market shares, where revisiting this market outcome in which our oligopolists are coordinating with one another, here we have our graphical representation of our market for our skate shoe industry. Price on the vertical, quantity of shoes on the horizontal. We have our downward sloping market demand curve in blue. We have our upward sloping industry marginal cost curve in black. Downward sloping marginal revenue curve for the industry in green, that's strictly below our market demand curve, and our U-shaped industry average total cost curve. Profit maximization occurs at the intersection of marginal revenue and marginal cost, which we see occurs at point D, giving us the output level S0 in terms of shoes to be produced and sold. Moving up to our market demand curve using the S0 quantity, we see that the pricing decision is P0. So in equilibrium, the skate shoe industry has an S0 quantity in terms of shoes, and the price point is going to be P0. Where, in regards to this, we also see that for the industry, positive economic profits exist. Recall that profits can be calculated as the difference between price and average total cost, scaled by total quantity, where here price is going to correspond to our market demand curve, and we see that this is strictly above our purple industry average total cost curve. So profits per unit is going to be positive, and when we scale that by our quantity level S0, we'll have positive economic profits as a result. We also see that some consumer surplus exists, where consumer surplus is going to be the difference between what consumers are willing and able to pay and what they actually pay, where this is going to be examining the price point on our market demand curve for B, C, and D, and taking the difference between our actual price of P0 and summing across. So price point at B minus P0 plus the price point at C minus P0, and then summing that with the difference between the price point at D, which is P0, and the actual price of P0 of 0. So some consumer surplus exists. So then to recap, profits were maximized at marginal revenues equal to marginal cost, which gave us our output determination using this rule, and using this output level, we then determined our pricing strategy by moving up to the market demand curve, where we saw that some positive economic profits existed given that our price point was above average total cost. And in terms of evaluating consumer surplus, we saw that there was some, as we saw was evident with the monopoly case as well. So in regards to this market outcome then, all firms must be in agreement with their market share as well as profit levels. If not, the coordination fails such that a firm could deviate by cutting price to retaliate in order to gain market share, where we saw that this leads to further price reductions as we saw with our price decrease game, in that if one firm decides to decrease their prices, the other firms will follow suit and decrease their prices as well, as that was the solution to our game, where with price reductions leads to a market outcome with reduced prices and an increased level of output in equilibrium. So then it would deviate from the monopoly outcome, and it would vary somewhere between the monopoly and competitive market outcome. So then, with this in mind, let us now compare this market outcome of the oligopoly industry that's coordinating to that of the monopoly market structure. So here we have our oligopoly industry on the left. This is precisely the same as the graphical illustration that we saw on the previous slide. And then on the right, we are now introducing our monopoly market structure. We have our downward sloping market demand curve for shoes in blue, our downward sloping marginal revenue curve for the monopolist in green, strictly below our market demand curve, our U-shaped average total cost curve for the monopolist, and then we also have our upward sloping marginal cost curve for the monopolist in black. Profit maximization occurs at the intersection of marginal revenue and marginal cost, which we see also occurs at point D, giving us an output level of S0 for the monopolist, where they then use this quantity level to price their good or service on the market demand curve, which we see corresponds to the price point P naught. So then we see that in equilibrium, the monopoly outcome is equivalent to that of the oligopoly industry that is coordinating, where this makes sense, given that the oligopoly industry is coordinating to mimic a monopoly. As such, we also see that profit levels are going to be the same. It's going to be the difference between our price point minus our average total cost, which we see is positive. Scaling that by our quantity level S naught, we'll have positive economic profits identical to that of what we saw when we analyzed the oligopoly industry that's coordinating. And in regards to consumer surplus, the difference between the price point on our market demand curve at B and P naught, adding that to the difference between the price point on our market demand curve from C and P naught, and taking the difference between the price point on our market demand curve at D and P naught, and summing those together will generate our consumer surplus, where this too is also identical to what we saw in our oligopoly industry case. Where, to recap then, what we saw is that the coordinating oligopoly and monopoly will yield the same market outcome, and that they will generate the output level S naught at the price point P naught in its market equilibrium, in which positive economic profits exist and some consumer surplus exists as well. So then, now moving on to our other market structure that we've considered, let us compare our coordinating oligopoly to that of a competitive market, where we have our coordinating oligopoly on the left, the same as before, and then on the right hand side we now have our competitive market, where we have our downward sloping market demand curve in blue, upward sloping market supply curve in red, where the upward sloping market supply curve is going to be identical to the industry marginal cost curve that we see on the oligopoly industry that's coordinating on the left. For the competitive market, equilibrium occurs at the intersection of market supply and market demand, which we see occurs at the output level S1, where at the output level S1 our price point is going to be P1, where this outcome will lead to a short-run equilibrium for a competitive market in which we'll assume positive economic profits exist. And in terms of consumer surplus, this is going to be taking the difference between the price point on our market demand curve and the actual price paid of P1 for points B, C, D, E, and for a market equilibrium point, where we will see that consumer surplus is strictly larger than the consumer surplus that's generated for the coordinating oligopoly. And then in terms of calculating the long-run equilibrium for the competitive market, this requires us to turn our attention towards the coordinating oligopoly industry graph on the left, locating minimum average total cost, which occurs at this second point on the average total cost curve, and then moving horizontally until we intersect the market demand curve, which we see corresponds at the output level S2. And so the long-run equilibrium for this competitive market is going to be at an output level S2 and at a price point P2, which we can also identify now here on our competitive market graph on the right, S2 and P2, which we see has a further increase in output and a further reduction in the price point. And if we were to further calculate consumer surplus, we would see consumer surplus is larger in the long-run equilibrium than the short-run equilibrium, and as a result is still larger than the consumer surplus generated in the coordinating oligopoly case as well as the monopoly case as a result. And in terms of economic profits now, since this is a long-run equilibrium, price is equal to marginal revenue is equal to marginal cost is equal to minimum average total cost. We have zero economic profits. So then what we saw is that the coordinating oligopoly led to an equilibrium in which the output level was S naught at a price point of P naught, in which we saw positive economic profits existing, as well as some consumer surplus existing as well. Where in regards to the competitive market, our short-run equilibrium had an output level S1 and a price point of P1, where S1 was strictly greater than S naught, and P1 was strictly lower than P naught. And our long-run equilibrium had an output level S2 and a price point of P2, where S2 was larger than S1 and P2 was smaller than P1. Where overall we saw then also that there were positive economic profits in the short run, but zero in the long run for the competitive market, and that there was a large amount of consumer surplus. Where comparing these two then, The competitive market led to an equilibrium that had a higher level of output and a reduced price point in equilibrium compared to that of our coordinating oligopoly, and that the competitive market led to an outcome in equilibrium with a larger amount of consumer surplus than our coordinating oligopoly, but that our coordinating oligopoly had a larger level of economic profits when compared to our competitive market. So then overall what we have is, as an oligopoly, through coordination, they will mimic the monopoly market structure and mimic the monopoly outcome as a result, in which the equilibrium will be the same as the monopoly market structure, which we saw was the output level S0 and the price point P0, in which a low amount of consumer surplus exists, and there will be positive economic profits. Where if this coordination, though, can't be sustained, as mentioned earlier, through some deviation of a firm that retaliates by decreasing their price to get more market share, the other firms will follow suit in this pricing game and decrease their prices. Overall, this will then have the effect of decreasing market price in equilibrium and raising the output level in equilibrium as well, such that when coordination is not sustained, the equilibrium for the oligopoly will lie somewhere between that of the monopoly and competitive market structure outcomes, where output will be between S0 and S2, that is the output level of the monopoly, and that of the long-run equilibrium for the competitive market. And in terms of the pricing strategy, it will lie somewhere between P0 and P2, that is the pricing decision for the monopoly and the pricing decision for the competitive market in its long-run equilibrium case. In which case, we'll still expect some consumer surplus to exist, as well as some positive economic profits to be anticipated and existing as well.